Okay, hope we are good. So we can continue with the discussion. And this is a revision for advanced financial reporting. And we are revising on chapter 2. We are through with our syllabus, and we've been revising on the previous chapters. That is chapter 1. We did finish chapter 1, where we did revision on several areas like leasing. We also did a revision on share-based payments, um, things like impairment, deferred taxes, among others. You can get those lessons in our YouTube. So remember to subscribe to our YouTube, Fatima Institute. Now we continue with chapter 2, revision, and this is specifically group accounts where you have things like joint ventures, investment in associates, things like subsidiaries, things like NCI, things like goodwill, and also cash flow statements. Again, you have finished doing cash flow statements, whereby we discussed about how to prepare cash flow statements using direct method as well as indirect method. Now, other areas which are to be covered in this chapter is foreign subsidiaries, how to account for foreign subsidiaries, as well as piecemeal acquisition and piecemeal disposal. Now, in this area to do with the piecemeal disposals and acquisitions means that you can start the year with a subsidiary, then within the course of the year, you dispose a certain percentage of that subsidiary, and therefore it becomes maybe an associate or it becomes a joint venture. For example, if by the start of the year you have invested 80% in company S, then by June, out of this 80%, you dispose 40%, then it means by the end of the year, that company is not a subsidiary, it is an associate. Again, you can start the year with an associate that is maybe that percent investment in an associate. And then within the course of the year, you acquire extra percentage, like say for example, 40%. So if you started the year with investment of that percent, within the course of the year you acquire 40%, then that company is no longer an associate. As you close your books of accounts, that company will be a subsidiary. So that is to do with piecemeal acquisitions and disposals within the course of the year. And those are the major areas which are covered in this chapter. That is accounting for foreign subsidiaries or accounting for foreign group members, accounting for disposals and acquisitions, piecemeal disposals and acquisitions, and then consolidated income statements and consolidated statement of financial position, as well as consolidated group cash flow statements using either direct method or indirect method. But the most recommended method for presentation of cash flow statements as per IAS 7 is the indirect method. Okay, I can just check from here for the purpose of confirming just what is required in your syllabus is chapter 2 is what we are revising, and this is preparation of financial statements for interests in other entities. This is advanced financial reporting, CPA. So chapter 2 is preparation of financial statements for interests in other entities. Subsidiaries, including foreign subsidiaries, piecemeal acquisitions, reduction in shareholding, and disposals, as well as statement of cash flows, Accounting for associates and joint ventures, including foreign entities, and disclosures of interest in other entities. So basically, this chapter 2 is quite a small chapter. However, it requires a lot of commitment on your side because in all examinations, chapter 2 has to be tested. You must get a question from group accounts, either preparation and presentation of uh, consolidated comprehensive income statement or consolidated statement of financial position or cash flow statements. That is a must as far as the examinations are concerned. Now, yesterday we did a question which was to do with preparation of consolidated income statement. Now, we know what is involved in preparing consolidated income statement. That is, you get the sales of the parent plus that of the subsidiary. Do not consolidate the associate line by line. Do not consolidate again joint venture line by line. We should be able to understand whenever we are consolidating income statements, what standards are we supposed to observe? What are we supposed to do? So most important thing, what we said yesterday is that we do not consolidate the items of the associate or those of the joint venture, but we discussed about how to go about it whenever you are consolidating the income statement items. Again, another important thing that we discussed is how to calculate goodwill arising on acquisition using either a full provision method or partial provision method. Those are important things. Another important thing that you should know whenever consolidating income statement is to establish the date of acquisition. So compare whether the date on which the acquisition or the disposal of a group member occurred, so that you may know how many months before the end of the year. That will be important because you'll be doing some sort of apportionment of these items. Also consider intra-company sales of stock. Consider unrealized profits. Consider the portion of closing stock remaining unsold. Note how to go about that particular figure, sales to a group member. Intra-company sales of non-current assets. Things like intra-company sales of fixed assets or non-current assets, you consider the depreciation, how it affects the purchaser, among others. So basically, these are things that we discussed yesterday and other classes in our previous lessons. Now, because these classes are now for the purpose of revision, now we go straight away to our revision question, and we are looking at September 2021. September 2021, question 1, Advanced Financial Reporting. In this question, we are required to prepare or present consolidated income statement as well as consolidated statement of financial position. Yesterday we did consolidated comprehensive income statement. Now today, this question, we are going to take the two parts, comprehensive consolidated income statement as well as consolidated statement of financial position. Now, the consolidated statement of financial position will appear this way. However, I'll be explaining some of these concepts here as we discuss the entire question. Okay, Now, I will start by presenting that question to you. I will start by presenting that question to you, and we read it together. Now, I advise that you download that particular paper, and you'll be able to compare what we have with the solution. Now, I will read, we can read the question together as I present it before you. So you have said it is September 2021. September 2021. Question 1. Question 1. Now that question was carrying 20 marks, the entire question. Now let's read that question together. We read that question together. Now let's go together. Let's go together. I believe you have the paper with you. I believe you have the paper with you. Now let's have the question there. Let's have the question. On 1st October 2019, H Limited acquired 80% of the ordinary shares in S Limited when the retained earnings of S Limited was shillings 5,335 million. On the same date, H Limited acquired 40% of the ordinary shares in A Limited, paying shilling 16 per share. The acquisition of the ordinary shares in S Limited was through a share exchange of one ordinary share in H Limited for every 2 shares in S Limited. The market prices of H Limited's and S Limited's shares as at the date of acquisition were shillings 30 and shillings 18 per share, respectively. In addition, H Limited agreed to pay a further amount of shillings 25 per acquired share in S Limited on 1st October 2021. H Limited's cost of capital is 10% per annum, and 1 shilling receivable in 2 years' time has a present value of 83 cents. H Limited has not yet recorded the consideration on acquisition of the ordinary shares in S Limited. The draft financial statements of the group companies are as shown below. So you have statement of profit or loss for the year ended at 1st March 2020. Now you can see it there. You can see the items there. There are 3 companies: H Limited, which is a parent; S Limited, subsidiary; A Limited, associate. So you are given revenue. Revenue is the same as sales. Cost of sales, gross profit, distribution costs, administrative expenses, investment income, that is interest and dividends, finance costs, profit before tax, income tax expense, stock relief, profit and loss for the year. And then we are given statement of financial position. The statement of financial position is presented. Statement of financial position is at 1st March 2020. Non-current assets, property, plant and equipment, investment in A Limited, financial assets, inventory, trade receivables, cash and cash equivalents. So that is your statement of financial position has been presented there. Now it continues on the other side. It does continue. The statement of financial position continues on the other side. Continues on the other side. You can see from the other side. Continuation. Continuation. Equity and liabilities. Ordinary shares of shillings 10. Share premium. Retained earnings. And current liabilities. 8% loan notes. Current liabilities, trade payables, current tax expense. You are given additional information. Now let's see what is in the additional information. Now we can start additional information. Number one, at the acquisition, that's at the date of acquisition, the fair values of S Limited's identifiable net assets approximated their book values, with the exemption of an item of plant which and a fair value of shillings 200 million above its carrying value. The plant and the remaining useful life of 10 years. Straight line depreciation at the date of acquisition. Depreciation on plant is classified as part of cost of sales. The fair value of the plant has not been reflected in S Limited's financial statements. No fair value adjustments were required on the acquisition of A Limited. In addition, at the date of acquisition, S Limited and internally generated brand which the directors of H Limited believed to have a fair value of shillings 300 million. The brand and an estimated useful life of 6 years. Amortization charge is classified as administrative expense. Number two. We read number two. Immediately after acquisition of S Limited, H Limited invested shillings 250 million in an 8% loan note of S Limited. All interest accruing on to that 1st March 2020 had been accounted for by both entities. S Limited also and other loans in issue as at that 1st March 2020. Okay, number three. After the acquisition, S Limited sold goods to H Limited for shillings 500 million. S Limited and marked up these goods at 25% above their cost rather. H Limited and that percent of these goods in its inventory as at that 1st March 2020. Number four. H Limited's policy is to value the non-controlling interest of S Limited at its fair value at the date of acquisition. For this purpose, the market price of S Limited's shares at the date of acquisition is considered to be representative of the fair value. Number five. Impairment tests were carried out on that 1st March 2020, which concluded that due to poor trading performance, the investment in A Limited had been impaired to the extent of shillings 80 million. Number 6, S Limited paid dividends amounting to shillings 400 million before the year end. Number 7, all incomes and expenses of the three companies are deemed to accrue evenly over the year unless as otherwise specified. Number 8, other than the share exchange in the acquisition of the ordinary shares in S Limited, there was no other issue of ordinary shares by the group companies required. Number A, consolidated statement of profit or loss for the year ended that 1st March 2020. Number B, consolidated statement of financial position is at 1st March 2020. So that is a question. That is a question. You can try to look at it as I do the elaboration. So remember, it is September 2021, question 1, advanced financial reporting. We are revising chapter 2, group accounts, specifically consolidated income statement as well as consolidated statement of financial position. Okay, we are told that on 1st October, so I say that the first thing that we need to establish is what kind of a company are we dealing with? Are we dealing with, that is the group members in terms of the investment from the perspective of the percentages that we have acquired? Now, the first thing is to understand that here we have three companies. We have the parent, we have subsidiary, and we have an associate. Now, H is the parent company, which has acquired 80% of S Limited, and they have also acquired 40% of A Limited. So in that case, we should establish the group members. Here we have three companies, and we are able to establish that H is the parent, S is the subsidiary, and A is the associate. Because we are told on 1st October 2019, H Limited acquired 80% of the ordinary shares in S Limited when the retained earnings of S Limited were shillings 5,335 million. So in a subsidiary arises where we have acquired, where the investor has acquired more than 51% or more than 50%, where an investor has acquired more than 50% of the shares of the investee. So in this case, we are told H Limited acquired 80% of the shares in S Limited. So definitely S Limited will be a subsidiary. And we say the remaining now, whenever you have a subsidiary, the remaining shares which have not been acquired by the parent are taken up by the non-controlling interest, the NCI, which is also known as a minority interest. So in this case, when H acquired 80% of S, the remaining 20% was taken over by the non-controlling interest or the minority interest. That's one point. So we have identified S as a subsidiary based on the number of shares acquired. The point continues. On the same date, H Limited acquired 40% of the ordinary shares in A Limited, paying shilling 16 per share. Now, A Limited becomes an associate because we have acquired 40%. A subsidiary, we say the acquisition is more than 50%. If it is 50%, 50%, then that is known as a joint venture. Now, if it is less than 50%, but more than 20%, then that is known as an associate. If we acquire any percentage below 50%, but above 20%, then those are known as associates. So definitely here you can see the 40% is not more than 50%, it is not 50%, it is not less than 20%, so that is an associate. But if it is less than 20%, then we talk of financial instruments. Now that is something that we are able to know from our previous lessons. So we have established in our question these group members. Now the other thing that we should establish is the date of acquisition. Now this company, they close their books of accounts on that 1st March 2020. That 1st March 2020. So if that is based on the requirement, because we are told to prepare consolidated statement of profit or loss for the year ended that 1st March 2020. So obviously, it means this is the date when these companies prepare their financial statements, that 1st March 2020, meaning their year starts on 1st April. 1st April. So if the year ends that 1st March 2020, their year means it started on 1st April 2019. So when was the acquisition? If the year starts 1st April 2019, they close the year, that year, March 2019, then you identify the date of acquisition. When was the company acquired? Is it a full year subsidiary? Is it a 6-month subsidiary? Is it a 3-month subsidiary? Because when presenting this information, it means that part of the year we were not having this subsidiary and associate. But part of the year we were having this subsidiary and associate. So we have to apportion that particular period. But when you go to next year, you not apportion the period because you'll be having these associate and subsidiary for the entire period, not unless they are disposed. Okay, let's have that point. We are told 1st October 2019, H Limited acquired 80%. So these acquisitions took place on 1st October 2019, and we are closing the year on that 1st March 2020. So how many months from the date of acquisition up to the end, from 1st October 2019 up to the close of the year, up to the end of the year, up to that 1st March 2020? I think those are 6 months. Okay, so once we establish that, the next thing now we want to show our workings. I'll be showing the workings step by step. I'll be showing you my workings. Now let me illustrate what I have mentioned to you so that you may go, just take your, be taking notes. You can just be writing the workings from this side. Now the first working that you should show is the first workings that you can show. You see that we have said H acquired 40% of A. They also acquired 80% of S. So A is an associate and S is subsidiary and H is the parent. You can see that that's important thing as far as your workings are concerned. Then from there, date of acquisition. This company is closing the year that 1st March 2020. That is the balance sheet date. You can see this drawing here, these small lines here. We are showing this company, they closed their year that 1st March 2020. That is the balance sheet date. The date of acquisition was 1st October 2019. So from 1st October 2019 up to that 1st March 2020, there are 6 months. The remaining from 1st April 2019 is also 6 months. So we brought in this associate and subsidiary 6 months before the end of the year. So these are important points to show there. Now let's continue analyzing our question. I want to analyze another important point there, whereby, and what, now you can write working number 1. You write purchase consideration to acquire S Limited. How much did we spend to acquire S S Limited. Now, we want to see how much did we pay to acquire that particular company. Now, if you can read, so we have done that particular portion. So we are told the acquisition of the ordinary shares in S Limited was through a share exchange of one ordinary share in H Limited for every 2 shares in S. The market prices of H Limited and S Limited shares as at the date of acquisition were shillings 30 and shillings 18 per share respectively. Now, can you check that point and tell me how much we are going to pay? Are you able to get how much really are we going to pay? I don't know whether you are able to attempt that. Try first, and then I show you the solution. How much did we pay? Okay, your working number 1. Check your working number 1. Assume you have attempted that. Purchase consideration to acquire S Limited. Ordinary shares acquired. We acquired 80%. You look at the total shares in S Limited. In S Limited, we are taking 80%. We are taking 80% times 500. The purchase consideration to acquire S Limited. We are taking 80% of 500. 80% of 500. So we acquired 400 shares. The remaining 20% goes to NCI. So NCI acquired 100 shares. Now, why are we using 500 shares? Now, this is the reason, because we are saying H Limited acquired 80% of the shares in S Limited. Now, go to statement of financial position. You can see ordinary shares of shillings 10. The first company was the parent, 8,000. The second company, the 5,000, is S, and the last company is the associate. So what we are acquiring is the ordinary shares of shillings 10 each in S. The ordinary shares in S Limited is a 5,000 that you can see there. But the par value is shillings what? 10. So how many shares are there? 5,000 divided by 10. We have 500 shares. So that 500 shares, the 500 shares is the portion that we are acquiring. Is a point clear? I think so. So you can say the number of shares that we acquired. Ordinary shares that we acquired is 80% of 500, which is 400 shares. The remaining 20% obviously was taken by non-controlling interest. Whenever you have a subsidiary, the remaining part goes to NCI. We wrote important point there, NB. To get 500 shares, we have divided shillings 5,000 ordinary shares by shillings 10, which is the par value. Then, one ordinary share. Now we want to convert these shares into shillings so that we may see the value in shillings. One ordinary share is 2 ordinary shares in S. That's the share exchange agreement. That is what we are told. They are exchanging for every 2 shares in S Limited, we are receiving 1, or the other way around. Then you ask yourself, what about 400 shares? Because 400 shares is what we acquired. 80% of the total 5,000 shares, 500 shares, in other words, is what we acquired. So what about, so if one ordinary share, we are exchanging at 2 ordinary shares, then we are saying 1 ordinary share in H for every 2 ordinary shares in S. What about the 400 shares that we acquired? Will be how many? Then convert into shillings by multiplying by 30. So 400 times 1 over 2 times 30. Because those shares in the books of the parent, they are valued at shillings 30. That is what we have been told. So 400 times 1 over 2 times 30 is equals to shillings 6,000. So that is the purchase consideration for those particular shares in the books of the parent. It's like saying that the parent paid shillings 6,000 to acquire 80% of the shares in S Limited. The remaining went to NCI. The remaining, we have said, is 100 shares, the 20% of 500. 100 shares. Now remember, the NCI purchases direct now from the market. For the NCI, there is no share exchange. We are not exchanging the shares. The assumption that we are making is that when the parent paid 6,000 shillings to acquire the subsidiary, then the NCI went to the market and purchased the shares of the subsidiary at shillings 18, and there are 100 shares, so the NCI paid shillings 1,800. I think that is well explained, and we have the summary there of those purchase considerations. S Limited paid shillings 6,000, and NCI paid shillings 1,800. So that is important workings there. So that is your working number 1. So show your workings and you go through it. You can start with the illustrations from the start, go to working number 1, and then we move to working number 2. Purchase consideration to acquire A Limited. How much did we pay? How much did we pay to acquire the associate? How much did we pay to acquire the associate? Now, that is the same point. It was a continuation of the same point, whereby you had been told. Now, if you can just go through that particular point, you can see that the acquisition of the ordinary shares in S Limited was through a share exchange of 1 ordinary share in H Limited. Is that what we've been told then? Is that the point? The acquisition of the ordinary shares in S Limited was through a share exchange of 1 ordinary share in H Limited for every 2 shares in S Limited. Now that portion we have done. The market price of H Limited's and S Limited shares is at the date of acquisition was shillings 30 and shillings 18 per share, respectively. So that is in your working number 1. In addition, H Limited agreed to pay. Now, I think that is not what I'm looking for. Just go to the start of that question. That is where the associate is. On 1st October 2019, H Limited acquired 80% of the ordinary shares in S Limited when the retained earnings of S Limited were shillings 5,335 million. On the same date, now that is be our working number 2. On the same date, H Limited acquired 40% of the ordinary shares in A Limited, paying shillings 16 per share. So that is a portion
which we are using to show our working number 2. Okay, so we need to see the total shares in S Limited, that is in the associate. We are acquiring, you can see ordinary shares for associate is 3,000. 3,000. Remember the par value is shillings 10. The par value is shillings 10. So out of these 3,000, we are getting 40%. We are purchasing 40% of those shares. So how many shares are there? 3,000 divided by 10 is 300. So out of the 300, we are acquiring, what are we acquiring? Yeah, 10%. That, we are acquiring 40%, yeah, right. So we are saying, we have seen in the associate, we have 3,000 shillings shares per value of 10. So we took 3,000 divided by 10, which is 300 shares. We acquired 40% of these shares at shilling 16. So 3,000 or 300 times 40%. 40% is what we acquired in that associate times shilling 16. We get 1920. Okay, so we are interested with 1920, what we paid to acquire, the associate. That's our concern. So that is our working number 2. So show your working number 2. These workings are very important because when preparing consolidated income statement and consolidated statement of financial position, we'll be referring to those numbers. Then working number 3 is deferred consideration. Now we have promised to pay some amount for the shares in the future. So that promise which you have made to pay for the shares in the future, it should form part of the purchase consideration. It is simply known as deferred consideration. What you do is to calculate the present value of what you promise to pay in the future. The deferred consideration. A small concept that we have done in financial management, computing the present value of cash flows. Now, you promise to pay some amount in the future. Now, I want you to look at that point there. In addition, what are you told? In addition, H Limited agreed. That's what I'm looking for. You can read out from there. In addition, H Limited agreed to pay a further amount of shillings 25 per acquired share in S Limited on 1st October 2021. H Limited's cost of capital is 10% per annum and 1 shilling receivable in 2 years' time as a present value of 83 cents. H Limited has not yet recorded the consideration on acquisition of the ordinary shares in S Limited. So, this is a deferred consideration. We are told in addition, H Limited agreed to pay a further amount of shillings 25 per acquired share in S Limited on 1st October 2021. H Limited's cost of capital is 10% per annum and 1 shilling receivable in 2 years' time has a present value of 83 cents. H Limited has not yet recorded the consideration on acquisition of the ordinary shares in S Limited. Now what I do is that I will calculate the present value of the future payments as at today, and I will consider that as a deferred consideration. that present value should form part of my purchase consideration. So show your workings. Working number 3, deferred consideration. Now you take the 25 times 400. Remember, we purchased 400 shares. We showed that working number 1. Working number 1, we showed the number of shares that we purchased in S Limited, 400. So we are taking, because you promised to pay 25 shillings in the future, you take 25 per share, 25 shillings per share, times 400, the number of shares, times the present value interest factor, which they have calculated for you, 0.83, and the deferred consideration. So that value as at today is 8,300. Now I've tried to elaborate that one, that point down there. It's like saying 1 plus rate raised to negative 2. You are told the cost of capital is 10%. So it's just like taking 1 plus 10%, which is 1 plus 0.1, raised to negative 2, because they are to pay in 2 years. So by the end of the day, you arrive at the same answer, 8,300. So shillings 8,300 will be part of the purchase consideration. So you can see working number 3. Now working number 4 is about revaluation of plans. Revaluation of plan. Now let me clarify something there. A very important point about, because in all these questions you find a situation where you are told that a plant or part of PP has been revalued, or maybe there is a brand, or there is a intangible asset which is being revalued. Now, if, for example, you are told that there is an amount which is above the carrying amount. Carrying amount is the same as net book value. We did that in chapter 1, impairment. So any amount, if you are given the carrying amount of an asset, and then you are told there is an amount above the carrying amount, that amount which is above the carrying amount is a sort of revaluation gain, is a revaluation, that extra figure. And therefore it means when you are closing your books of accounts, your asset now will be a little bit higher because of the revalued figure. Again, that extra figure which is above the carrying amount should be subjected to impairment, or it should be depreciated. You should ask yourself, what is the expected life of that particular asset? And then calculate the depreciation per year, and then you apportion that depreciation based on the time within which we acquired this particular group member. If, for example, is a 6 months subsidiary, then you apportion that depreciation within 6 months. So that's the portion. It's quite simple. It's straightforward. Now let's see where our working number 4 is originating from. I want to see where working number 4 is originating from. Now you go to additional information number 1, and that is where that information is originating from. Working number 4 will be from point number 1. Read point number 1. At the date of acquisition, the fair values of S Limited's identifiable net assets approximated their book values, with the exemption of an item of plant which had a fair value of shillings 200 million above its carrying value. Above. So the 200,000 is above. There is above the carrying value. So that is a revaluation, sort of revaluation gain. The plant had a remaining useful life of 10 years, straight line depreciation, at the date of acquisition. Depreciation on plant is classified as part of cost of sales. So when you start consolidating statement, income statement, that depreciation will be considered as part of cost of sales. Okay. The fair value of the plant has not been reflected in S Limited's financial statements. No fair value adjustments were required on the acquisition of A Limited. In addition, at the acquisition of uh, S Limited, now that point, let me check that one again. You're saying, in addition, at the date of acquisition, S Limited and an internally generated brand with the directors of H Limited believed to have a fair value of shillings 300 million. The brand and an estimated useful life of 6 years. Amortization charge is classified as an administrative expense. So that will be going to administrative expense. But let me show you the workings for that. Just as I have explained, now I saw your working number 4 is to show the revaluation of plant. So show your workings. Working number 4. Working number 4, revaluation of plant. We said impairment occurs when the carrying amount exceeds a recoverable amount. The opposite is evaluation gain. That one you have done in chapter 1. Now, you are told in additional information number 1 that what was above the carrying amount was 200. This 200, we are told, this particular asset has 10 years expected life. So 200 divided by 10 to get depreciation per year. So 200 divided by 10 is 20. So per year, that depreciation is 20 times 6 over 12. We are saying 6 over 12 because that subsidiary was a 6 months subsidiary. Now remember here, if you don't know that's why we're using 6 months. We acquired this subsidiary on 1st October 2019. We have it from 1st October 2019 to that 1st March 2020. So these are 6 months. So that is why we are portioning that depreciation. That is why we are taking 200. We are taking 200 over 10 because the expected life is 10 years. We get depreciation per year, which is 20. 200 over 10 is 20. Then for this year, which we are preparing the books of accounts for, we are only interested with the 6 months. So you divide by 6 over 12, you get 10. And you are told this is part of cost of sales. So that 10 is very important. Okay, we move to working number 5, which is amortization. The same point number 1. You are told there was an asset there. It was a brand, working number 5, that brand, and a value of 300 with expected useful life of 6 years. So take 300 over 6 to get amortization per year. Then we are interested with only 6 months for this particular question, times 6 over 12, which is 25. And we are told that will be part of administration expenses. Okay. That is done. I go to another point. I will move to another point. And that is point number 2. Point number 2. Point number 2. What were you told in point number 2? Immediately after acquisition of S Limited, S Limited invested shillings 250 million in an 8% loan note of S Limited. All interest accruing to that 1st March 2020 had been accounted for by both entities, S Limited also, and other loans in issue as at that 1st March 2020. Now basically, this is a loan, and if it is S Limited, H Limited invested in H Limited invested in S Limited. So obviously, H Limited will be receiving interest. Now, this is a sort of financial instrument. So if H Limited has invested in S Limited will pay interest, and H Limited will receive interest income. But these are group members. You can't really invest in yourself. So those transactions will have to be eliminated. As interest income and as interest expense, you'll be less in that. But first, what is the interest? It is 8%. Working number 6. It was 8% times 250 times 6 over 12. Huh? That interest was received and paid for only half a year. So this 10, it's a parent which invested in the subsidiary. So the subsidiary must pay interest of 10 for that 6 months, and the parent will be receiving this 10 as investment income. But when we start consolidating our income statement, where you have interest income, you less that 10, you can receive money from yourself. And for interest expense again, you less the same 10, you can pay to yourself. Okay, go to working number 7, which is intra-company sale of goods. Intra-company sale of goods, that is point number 3. Elaborate point number 3 will be your working number 7. Point number 3. Point number 3. After the acquisition, S Limited sold goods to H Limited for shillings 500 million. S Limited and marked up these goods at 25% above their cost. H Limited had that percent of these goods in its inventory as at 1st March 2020. So these are intra-company sales. You know how to go about intra-company sales. Okay, that is working number 7. Your working number 7. Can look at working number 7, intra-company sales. As the subsidiary sold to the parent goods worth 500,000. So we need to, by the end of the year, that percent of these goods had not been sold. So in the closing stock, we have 150. So out of the 150, the remaining goods unsold. You see, the 70% which had been sold. In other words, if we are remaining with 150, obviously, 350 had been sold. So the profit relating to 350 has already been realized. But the fact that we have goods worth shillings 150 in the closing stock, that profit has not been realized. So we need to calculate the unrealized profit on the closing stock. So we are using markup. Goods had been marked up at 25%. So 25 over 100 plus 25, which is 25 over 125 times 150. So the unrealized profit is shillings 30. So this shillings 30, because the profit is with the subsidiary has to take 80% of that, and NCI will take 20%, the remaining. You can see our calculations there. Okay, so that is how we go about the working number 7. Okay, we go to working number 8, and that is to do with goodwill. Now, goodwill on acquisition of S Limited. When we acquired S Limited, what was the goodwill? Now, goodwill on acquisition of S Limited, purchase consideration, you refer to working number 1. We paid 6,000. The parent paid shilling 6,000 to acquire the subsidiary. Refer to working number 1. Then we plus deferred consideration. Working number 3, 8,300. The deferred consideration, that figure which we promised to pay in 2 years' time. 6,000 plus 8,300. Then fair value of NCI is also in working number 1. How much the NCI paid to acquire the remaining 20%, 1,800. So 6,000 plus 8,300 plus 1,800, you get 16,100. Then net assets acquired, go to the ordinary shares, share premium, retained earnings. The profit is at the date of acquisition, and then revaluation. We revalued PP at 200, the brand 300. You sum them together. Now, ordinary shares and share premium, what we are acquiring. Remember, we are acquiring S Limited. Maybe you don't understand where these figures are coming from. The equity part, what we are acquiring is equity, the second company, ordinary shares, 5,000, share premium, 2,500. So we are acquiring those items. You can see 5,000 is what we are acquiring. Share premium, 2,500. That's what we are acquiring. Then, profit as at the date of acquisition. We use profit as at the date of acquisition. If you read that point number 1, 53.5 is what we acquire. The profit as at the date of acquisition. So when you say ordinary shares of 5,000 is the ordinary shares in S Limited, in the statement of financial position, share premium 2,500 is given. Retained earnings is a profit as at the date of acquisition. Then revaluation. Then the assets were revalued. So the items, these are revaluation reserves. The revaluations, you find them in additional information number 1. Items were revalued. Additional information number 1. So the goodwill, we are using full provision. We are using full provision method. So that is how we calculated our goodwill. Purchase consideration, working number 1. Deferred consideration, working number 3. NCI, fair value of NCI, working number 1. You sum them together, then you less net assets. Ordinary share capital of S Limited, share premium of S Limited, retained earnings as at the date of acquisition, then revaluation. That is in additional information number 1. 200, the PPE, and 300, the brand. You less all that. So goodwill on acquisition is 2765. So that is working number 8. Okay, we have working number 9. We want to see investment in associate. Remember, we don't consolidate associate. What you do is we calculate what is the investment in associate. What is the investment in associate? So you take the purchase consideration. In working number 2, refer to working number 2, and you get 1920. You earn group share of post-acquisition profit. Now the associate made a loss of 600. So what we are acquiring is not a profit. What we are acquiring is a loss. Now if you look at, can you see this 6,000 here? This 600 here. This figure here. In your statement of profit or loss for that year, A Limited, profit and loss for the year, 600. So out of this loss, we got, because we had invested 40%, we are getting 40% of that. and then you multiply by 6/12 because we have this associate for only 6 months. So that's purchase consideration, which is in working number 2. We are doing investment in associate. Working number 2, we got 1920. We earn group share of post-action profit. In this case, it is not a profit, it is a loss of 600 times 4%. We had invested 4% times 6/12. Then there was impairment loss of 80. So loss of 80, we have been told somewhere. We have been told somewhere that number 5, you can read number 5. Number 5, impairment tests were carried out on that 1st March 2020, which concluded that due to poor trading performance, the investment in Air Limited had been impaired to the extent of shillings 80 million. So we are lessing the 80 million. So the investment in associates is 1720. The investment in associate is 1720. The other thing is to have retained earnings account. Working number 10. Working number 10. Start with the balance brought forward. 12,100. We are preparing the retained earnings account. Balance brought forward is 12,100. Okay. You go to statement of financial position as at 1st March 2020, and the figure has been provided. 12,100 is here. Retained earnings 12,100. 12,100 is the balance brought forward. Now, once you take that, again, that is from the side of the parent. Then, in the subsidiary, you take 80% times 6,700 minus 5335. So again, so you can see in the retained earnings account on the credit side, you can see retained earnings, you have taken 12,100. Then the subsidiary, you take 6,700 minus profit as at the date of acquisition. The profit as at the date of acquisition, we are told that the figure is 5335. The profit. So you are taking 6,700 minus 5335 times 80%. Times 80%. So that is where that figure is coming from. So we have analyzed the credit side of retained earnings account. Balance brought forward 12,100. That figure, you just take the entire profit for the parent. But for the subsidiary, what you bring on the credit side, you take profit as at the end of the year minus profit as at the date of acquisition. Then the difference you multiply by 80%, the proportion that we acquired. Now on the debit side, depreciation. There is that PPE which was valued upwards. Additional information number 1. Now we are taking 80% of 10. 80% of 10. And that 10 was, we calculated that in additional working number 4. If you look, you remember working number 4. Working number 4. Working number 4, that impairment of 10, revaluation of plant 10, you take 80% of that. You also take 10% of 25, working number working number 5, the amortization, that figure, 80% of that. So that is why on the debit side, you can see what is on the debit side. Depreciation, 80%. Remember, this subsidiary we acquired 80%. So we are sharing that depreciation for PPE, which was in additional information number 1. 80% of 10 is 8. Amortization, that brand was revalued upwards. We got 25. We take 80% of that. And you realized profit of 30. We say that there was sale of certain goods, and then part of it was not sold by the end of the year. 20, so we are taking that percent of the unrealized profit times 80%, you get 24. Then impairment of A Limited, we are told there was impairment in the associate of 80. Then we are sharing a loss from the associate, meant a loss of 600. So out of this 600, we are sharing 40% of that. For half a year, we get 120. So the balance carried down, will be 12,940. So that balance carried down is very important. So retained earnings account. Then NCI, we are just taking the balances. So the NCI account, you can see balance brought forward is in the working number 1. Working number 1, we calculated how much the NCI paid. So they paid 1,800. Then profit for the year. Now we are told that the subsidiary made a profit of 2730. We are supposed to take 20% of that for half a year. So 2730 times 20% times 6/12, which is 273. So remember, the subsidiary made a profit of 2730 for the entire period. On the debit side, and you realized profit 30, you take 20% of that. Depreciation 10, you take 20% of that. Amortization was 25, 20% of that. Then the balance carried down 2070. Okay, I think we are through with that. Now, because we did statement, consolidated statement of profit and loss yesterday, then I'll just present to you how the consolidated profit and loss will look like. Now what you do is that you take the sales, you have your past paper, you take the sales for the parent, 2,500, 25,500 is the sales or revenue, plus sales of the subsidiary 18,000 times 6/12. Then you minus 500, the intra-company sales. We are told that there were sales between the group members worth shillings 500. H sold to, maybe the H sold to S, goods worth 500. So you can't sell goods to yourself. So you are just summing up the revenue as given in the statement, the income statement for the year. Revenue 25,200 for the parent plus 18,000 of the subsidiary. But this 18,000, those sales we apportion them in 6 months. Then you are minusing 500, the intra-company sales. You get 33,700. Cost of sales. The parent 15,120 plus 12,000 times 6/12, we plus 10 plus 30 minus 500. Now, what is 10? We are told that there was a PPE which was valued upwards. Additional information number 1. So we calculated a certain depreciation there, and we are told that depreciation should be part of the cost of sales. So the 10, then unrealized profit is overstating our closing stock. So you plus the 30, which is the unrealized profit. Then you minus 500. You cannot purchase goods from yourself. Remember, you less the 500 sales. You can see it is up there. You also minus it as well. Cost of sales, the 500 there. So that's cost of sales. So gross profit, 33,700 minus 26,610. You get that 10,040. Gross profit. Go to distribution cost. You take that from the parent, 1344. You are looking at these figures from the question paper. They are given from the income statement. Distribution cost, 1344 plus 840, which is for the subsidiary, times 6/12. Administrative costs or administrative expenses, 2196 for the parent, plus 1080 times 6/12. Then you plus 25. We were told the brand from additional information number 1. That brand, which was valued upwards, we got a depreciation of 25, and we are told it should be part of administrative cost. Finance cost, 220 from the parent plus 150 from the subsidiary times 6/12 minus 10. 10 is the interest finance cost. We are told that H invested in, I think, 8% of 250 million financial instrument, finance cost. That loan, 8% interest. 10, you can't invest in yourself. You can't pay interest to yourself. So you are minusing the 10, which was interest, which the parent invested in the subsidiary. So finance cost, profit after tax, you are getting 8230. Tax expense, take that of the parent, just as given in the income statement, 1800 plus 1200 times 6/12, 2400. Profit after tax, 5830. We earned associate share of profit after tax. Unfortunately, that was a loss. We have said 600 was a loss, and it was meant for 6 months. Then 40% of that, we earned associate share of profit after tax. In this case, it was not a profit, it was a loss. We also include the impairment of 80. We were told that that investment was impaired. So you minus 200. So profit for the year is 5630. Now this 5630, profit attributable to NCI is 260. So 5630 minus 260. I just refer to working number. I think we have done working number 12. So check here, working number 12. Working number 12 will be there. Profit and loss for the year by S Limited is there. Out of this profit, the NCI receives 20%, and the transactions were for 6 months. So we are shown here 2730 times 20% times 6/12. We are minusing 6 minus 2 minus 5. This figure there. 6 was an unrealized profit, and 2 was depreciation, and 5 was amortization. So you are left with 260. So working number 12 is there. So that is how we are getting this particular figure. Profit attributable to NCI, 260 260 is there. Then when you less that, what you are left with is what goes to the parent, 5370. So basically that is that should be H group statement of profit and loss consolidated. So it will be something like that. So that is the answer for number A. Now we go to answer number 5, which was my focus now. I presented before I got to, because that is appearing on the whiteboard, but if you can see it well, the statement, consolidated statement of financial position, would look something like that. PP, goodwill, intangible assets, investment in associates, current assets are there. Then total assets are there. Then you move to the other side and you get the conclusion, the final side, which is equity and liabilities. Equity and liabilities. The final side, the other side, that will be the other side. So ordinary shares. Now I can illustrate now this one from the other side because I see that that's the point that we are trying to undertake. Now let's see that from the other side. Consolidated statement of financial position. Consolidated statement of financial position. Now this the answer is there. H group consolidated statement of financial position. We start with non-current assets. I believe you have the paper. So what you do, consolidating, go to statement of financial position as at first March 2020. Property, plant and equipment for H is 25,000 plus that of S Limited 16,300 plus 200. Now 200 in additional information number 1. You are told that certain assets were revalued, fair value of 200 million. That is additional information number 1. At the date of acquisition, the fair values of S Limited's identifiable net assets approximated their book values with the exemption of an item of plant which earned a fair value of shillings 200 million above. So this 200, and again, those assets were depreciated. You have calculated depreciation and we got 10. So that is how your PP consolidated figure will look like. PP, take that value by the parent. As the figures are given, you just take them that way, plus that of the subsidiary, plus revaluation, minus depreciation on the revalued figure. You get 41. You get 41 for 19. Then goodwill, we have calculated goodwill. When we acquired the subsidiary S Limited, there was a goodwill of 2765. That is working number 8. We show that one as working number 8. Refer to working number 8. We got goodwill of 2765. Next, intangible assets is the brand. I think it's working number 5, which you'll find in additional information number 1. Number 1, this brand is intangible asset because we are told somewhere that in addition, at the date of acquisition, S Limited and internally generated brand, which the directors of H Limited believed to have a fair value of shillings 300. But this branch with a value of 300, there was a depreciation of 25. So 300 minus 25 is 275. Then investment in associates, working number 9. Refer to working number 9. We have shown all this. Your working number 9, investment in associates, we got 1720. You sum up all that, you get 46,250. Those are non-current assets. Then current assets, you take inventory. Inventory you take 6,700 for the parent plus 6,000 for the subsidiary minus unrealized profit of 30. So 30 is again in your workings. So 6,700 plus 6,000 minus 30, you get 12,670. That is the unrealized profit on the stocks. The total, remember 24 went to the subsidiary, 6 went to NCI. So 24 plus 6, you take the total figure here. Trade receivables, they are given 4150 for the parent plus 1,000 for the subsidiary. You get 5150. Remember, you don't consolidate the associate. Don't consolidate the associate. You are only taking the parent and the subsidiary. And here again, don't apportion on time basis. We don't apportion assets on time basis. What you apportion is income statement items. You can see in the income statement, we are considering if it is the sales, the 6 months. Okay. Then cash and cash equivalents, we have 1980 for the parent plus 400 for the subsidiary. You get 2380. You sum up that, you get that the total assets is 66,450. Total assets is 66,450. 66,450. Now, equity and liabilities, you take ordinary shares now. Now, remember, for assets and liabilities, you take that of the parent plus that of the subsidiary. For equity side, you only take that of the parent alone. So just go and take, in this case, you could have taken 8,000 because if you look at the statement of financial position, equity, ordinary shares for the parent is 8,000. You look at it from the question paper. That is H Limited. Ordinary shares of shillings 10 each is 8,000 for the parent. But why are we saying plus 6,000? You're saying plus 6,000 because when we acquired the subsidiary, we received share exchange. We received more shares valued at 6,000. So you are combining the 8,000 plus 6,000. Our shares increased on the side of the parent. So we have 14,000 in that case. So 6,000 is coming from the share exchange, working number 1. Okay, then share premium. For the parent, you take for the parent alone, share premium, 4,000. Share premium is 4,000. 4,000. Retained earnings refer to working number 10. That T account, which we have shown, working number 10. Retained earnings, the balance carried down, we got 12,940. Then NCI, working number 11. Now there are 2 T accounts which are very important in group. One is for the retained earnings. When consolidating statement of financial position, you usually use the balance carried down in that particular T account. So you have a T account there, our working number 10, which is retained earnings with balance carried down or closing balance of 12,940. Then NCI, the same, the balance carried out, the closing balance of 12,660. Then lastly, non-current assets. Non-current assets, no liabilities, non-current liabilities. Liabilities, you earn that of the parent plus that of the subsidiary. You sum them together. For equity side, you only take that of the parent. Now here, we have 8% loan notes. For the parent, 7,600 plus for the subsidiary, 2,000. However, we invested in 8% loan note in additional information number 2. We are told immediately after acquisition of S Limited, H Limited invested shillings 250 million in an 8% loan note. So you can, this is a liability, but is a loan note, but we can really invest in ourselves. That is when you are lessening this 250 loan note has been deducted. So 8% loan notes, 7,600 from the parent plus 2,000 of the subsidiary minus that intra sort of investment. You can invest in yourself. So you are left with 9350. Deferred consideration, working number 3. We say that the parent promised to pay 25 shillings per share. That is 25 of 400 times 0.83. That portion where we are calculating the present value of the particular payment to be made in the future. So that promise to pay is a liability. So that's a deferred consideration, and we got 8,300. Remember that 8,300 forms part of the purchase consideration. Working number 3. Current liabilities, we have trade payables. The trade payables, 5,500. These are in the question paper. The statement of financial position, they are direct. 5,500 plus that of the subsidiary, 5,200. You get 10,700. Then current tax payable, 2,800 plus 2,300, and we got 5,100. And you sum up that side, from here, you get 66,450, which is the same as the total assets. Remember, the basic accounting equation, that is total assets is equals to equity plus liability. So we are okay with that particular question. So I think that is our major focus was to help you to understand preparation of consolidated statement of financial position, because yesterday we did consolidated income statement. We know how to go about it. However, in this same question, we have also shown you how to prepare consolidated income statement. But my focus was to help you to understand how to prepare group consolidated statement of financial position. So important points here we have said is that when you are consolidating, don't consolidate the associate on line by line basis or even the joint venture. You can see what you are taking here is a PPE, the property, plant and equipment for the parent. Now these figures are given. You find them in the question paper. How much was the PPE in the parent, H Limited? 25,000 plus PPE in the books of the subsidiary, 16,300. 200 was the revaluation. PPE was revalued by 200. And the revalue figure was also depreciated. So the 200 is also, even though it has been revalued upwards, it is also depreciating by 10. So you are lessing that. So basically you are left with 190 here, this figure here. So you have consolidated the PPE. Goodwill, that occurred when we acquired the subsidiary. You have shown it there. Investment in associate is supposed to be reported as one figure. That's why we have said that you don't, this is an investment. An investment is a non-current asset. We don't need to consolidate all the assets all the liabilities, maybe circularly. So because investment is a non-current asset, when consolidating the statement of financial position, you only need to calculate one figure known as investment in associate, and you report that one figure as a non-current asset. And that is, you find it in working number one. We have been studying how to calculate this figure for a few days ago, and we are all conversant with how to calculate that figure known as investment in associate. And in this question, we have shown that again in working number 9. So once you sum up that, you go to the current assets, see whether there is anything to be adjusted. You just pick the assets for the parent plus that of the subsidiary. If there is anything which is affecting those assets, you had a lesser you pass, for example, here for the inventory, there was a realized profit of 30, which is overstating the profit, and therefore, or the closing stock, and therefore you have to less this, that here. You do the same with the others. For equity, you only consider that of the parent. You don't plus that of the subsidiary. You just take that of the parent. And then finally, the liabilities, and I think we have done all that. Okay, maybe I can present the question to you before we close the discussion. Maybe you want to see how the question looked like. The question was like that. That's where the question started. You can maybe have it, and you can do it on your own. You can take that question on your own, which was advanced financial reporting, question 1, which carried 20 marks. You can just take it again on your own, attempt that question on your own again, compare with what I've shown you. Compare with what I have shown you. Then I move to the next page. You still need that information. You do it on your own and compare with our solution. You can compare with our solution, especially the additional information, especially the additional information. Try to show consolidated statement of profit or loss and consolidated statement of financial position. Now, I briefly show you all my workings, because you have done them together. You have done all the workings together with you. So, my workings originally, that's where we started. You know where we started? You have all the workings with you. If you have been showing your workings, we started with establishing our group structure. Who was the associate and who was the parent and who was the subsidiary? The dates of acquisition, when the year ends, when the year starts, date of acquisition. We showed our working number 1, purchase consideration to acquire S Limited. We said there were 500 shares. We showed all the calculations up to 6,000. How much the NCI paid. We showed our summary there. Then working number 2 was how much was paid to acquire the associate. Working number 3 was deferred consideration. This amount was to be paid later, but again it forms part of non-current liabilities. Working number 4 was the revaluation of plant. How we got the 10. That 10 we have used it several areas. That was our workings in our page 1. Remember it is September 2021, question 1. Advanced financial reporting. Okay. The next page, we continued with our workings on the other page. we showed some amortization of branch, investment on the loan, the 250. You can see the 250, how it affected our consolidated statement of financial position on the board. You have said you can't lend money to yourself, so that figure was deducted. And the 10% interest, you have seen how it affected our consolidated income statement. Intra-company sales, you can make sales to yourself. You know how you eliminated the 500 as sales as well as purchases. And you realize profit of 30. You can see how 30 affected our closing stocks. We deducted that one in our consolidated statement of financial position. We deducted the 30 from our inventory. Goodwill, you see how we did our goodwill. We got 2765, and that figure has to appear in consolidated statement of financial position. After that, what else do you take? We continued with our workings. We continued with our workings elsewhere. Investment in associate, I have told you that we don't consolidate associate items line by line. We calculate one figure which we report as a non-current asset. In our case, 1720 is an investment in associate. You can see it in our question in the whiteboard. Retained earnings, you have discovered that the balance carried down is what you consolidate in the statement of financial position. 12,940, the balance carried down is what is to be consolidated in the consolidated statement of financial position. NCI, the balance carried down of 2060 is what you consolidate in the consolidated statement of financial position. Then working number 12 and 13, they can help you maybe to understand more about our finalization of our question. Okay, we went now to consolidated income statement, which we were required to show. You just pick the revenue for the parent plus that of the subsidiary, but you apportion the transactions of the subsidiary based on time, on timely basis. That's what you are taking. 25,200 was the revenue for the parent, plus 18,000 was the revenue for the subsidiary, but you multiply by 6/12 because you were with this subsidiary for 6 months. Minus 500, the intra-company sales. You can make sales to yourself. And the same figure, 500, you should less it as a cost of sales. Because when the parent is saying we sold goods worth 500, then the subsidiary is saying we purchased goods worth 500. So the 500 must be deducted as both sales and as well as what? Purchases on the side of cost of sales. You know how to calculate cost of sales? Is opening stock plus purchases minus closing stock, that is. So that's how we did that. I think we explained that. So your statement of profit and loss will be like that. Then group consolidated statement of financial position, we have explained that right now. Your PP, your goodwill, intangible asset, investment in associates, current assets are there. You have the total assets 66,450. This continues on the other page. And we have something like that. So that is how we have done our question. That is how we have done